The India growth story has caught the attention of global investors in the last 2 years, and with no small justification, with the country likely to be the fastest growing major global economy in the world in the coming years, and possibly for decades to come. Dramatic structural reforms, the demographic dividend, rapid digitalization and a massive infrastructure build-out are just some of the many drivers of India's long-term growth trajectory. At the same time, India's outstanding capabilities in providing IT, HR, legal and accountancy services to global companies is boosting exports and helping to structurally change the country's balance of payments situation, adding to the resilience of the economy. This and other more cyclical macro factors, such as a positive rates outlook and the likelihood of lower inflation, form a supportive backdrop for Indian bonds. One of the most anticipated and pivotal developments for the India bond market is JP Morgan's inclusion of Indian bonds into its GBI-EM index, which commenced in June of this year. Index flows related to JP Morgan and other potential index providers, along with strategic allocations, should result in tens of billions of US dollars of inflows over the next 3 to 5 years. The case for strategic allocations is backed by India bonds' compelling yields and portfolio diversification benefits. The market is also large and liquid, crucially operating against a backdrop of macroeconomic stability and transparent monetary policy. As a critical consideration for global bond investors, it's important to note that the rupee has not only outperformed against other currencies, but is also more stable today than compared to past periods. Accumulated foreign exchange reserves are now at a record high of 670 billion US dollars, which allows the Indian authorities to cushion currency volatility. The structural improvement in India's current account and strong investment flows should continue to support the rupee. Our HSBC India fixed income strategy can allocate to both local rupee currency bonds and US dollar bonds issued by Indian entities, and most often hedged to INR to create a higher synthetic yield. This means we can allocate to whichever of the markets we find the most attractive. This dual market approach is a hallmark of our strategy, allowing us to navigate different market cycles to capture the best value for our investors. Our portfolio is well diversified and invests across government, quasi-sovereign and high-quality corporate bonds. The strategy has not seen any defaults since inception, thanks to a prudent bottom-up credit selection process. For 12 years, our HSBC India fixed income strategy has been connecting global investors to relatively high-yielding bonds and an undervalued currency. One of our distinct strengths is our combination of domestic and global presence. A dedicated team of portfolio managers in Singapore and Hong Kong is supported not only by the firm's global fixed income platform, but also considerable investment resources domestically in India, giving us the local insight needed to successfully navigate this exciting investment opportunity.